Have you ever opened up Zillow or Redfin on a lazy Sunday afternoon, found a nice, completely average three-bedroom house listed for $500,000, plugged the numbers into an online mortgage calculator, and felt your stomach immediately drop? Look, we have all done it. You see a listing that is not even a mansion, it is just a standard suburban home built 25 years ago with updated kitchen cabinets, and the estimated monthly payment staring back at you looks like an executive salary. You sit back in your chair and think, who on earth is actually buying these homes? And how much money do you realistically need to earn so you do not spend every waking moment terrified of a single unexpected plumbing leak? Here is the thing that makes this topic so emotionally charged right now. For decades, we were handed a very specific cultural script: go to school, get a stable job, save up for a modest down payment, and buy a starter home. That was the baseline definition of responsible adult life. But somewhere along the line, the math completely broke. According to data from the National Association of Realtors and the Federal Reserve, housing affordability over the last few years has touched its lowest levels in over 4 decades. In 2020, when mortgage interest rates were hovering near 3%, the principal and interest on a $400,000 loan balance was roughly $1,600 a month. Today, with benchmark mortgage rates floating around 6.5 to 7%, that exact same loan size demands nearly $2,700 a month in principal and interest alone. That is an extra $1,100 vanishing from your pocket every single month before you pay a single dime for property taxes, homeowner's insurance, private mortgage insurance, or the lawnmower. Let us pull back the curtain and look at the real financial anatomy of a $500,000 house today, because the biggest mistake most first-time homebuyers make is confusing the mortgage payment with the total cost of ownership. Imagine a couple in their early 30s. Let us call them Marcus and Sarah. Marcus works in logistics management, earning $75,000 a year, and Sarah is an account coordinator bringing in $65,000. Combined, their household income sits at a respectable $140,000. By traditional standards, they feel successful. They drive reliable cars, they cook dinner at home 4 nights a week, and they manage to scrape together a 5% down payment of $25,000, plus another $10,000 for closing costs. They walk into a bank, get pre-approved for a $500,000 home, and celebrate over tacos thinking they have officially arrived. But watch what happens the moment they actually get the keys and move in. Because they put 5% down, their starting loan amount is $475,000. At a 6.8% interest rate on a 30-year fixed mortgage, their baseline monthly payment for principal and interest comes out to roughly $3,100. But the bank does not hand you the house for just principal and interest. Now comes property taxes. Depending on where you live, property taxes can easily range from 1.2% to over 2.5% of your home's assessed value. At a modest national average of 1.5%, that adds $625 a month directly into their escrow balance. Next is homeowners insurance. Climate risks, construction material inflation, and replacement costs have pushed average insurance premiums higher across the country. Marcus and Sarah are looking at least $175 a month for a standard policy. Because they put down less than 20%, the lender attaches private mortgage insurance, or PMI, which adds roughly $150 every month until they build enough equity. If their neighborhood belongs to an association, a modest HOA fee tacks on another $75 a month for basic community maintenance. When you add those pieces together, Marcus and Sarah are not writing a check for $3,100. Their mandatory housing check every single month is $4,125. Let that sink in for a moment. $4,125. On a household income of $140,000, their combined take-home pay after federal and state taxes, retirement contributions, and health insurance deductions is roughly $8,200 a month. That means 50% of their entire net cash flow is funneled directly into keeping the front door open. Think about what happens to the psychology of a household operating under that kind of pressure. The house ceases to be a sanctuary and becomes a financial prison. When the air conditioner compressor gives out in July, or the roof develops a leak after a heavy storm, there is no corporate landlord to call. You are the landlord. Financial planners typically recommend setting aside 1 to 2% of the home's total value annually for routine maintenance and capital expenditures. On a $500,000 home, that is $5,000 to $10,000 every single year, or another $600 a month you need to stockpile just to maintain the baseline value of the asset. When 50% of your income is locked into housing, a single auto repair or unexpected medical copay triggers genuine panic. You stop funding your investment accounts. You stop taking restful vacations. You start arguing with your partner over the grocery receipt because every single dollar feels painfully scarce. You end up being house rich on paper, but cash poor in daily reality. So who can actually afford this $500,000 house today without living under constant financial terror? To answer that cleanly, we have to look at the golden standard of sustainable personal finance, the 28% front-end debt-to-income rule. This guideline states that your total monthly housing cost, including principal, interest, taxes, insurance, and HOA dues, should not exceed 28 to 30% of your gross monthly income. If your all-in monthly payment on a $500,000 home sits around $4,000, you need a gross monthly household income of $14,285 to comfortably absorb it. That translates to an annual gross salary of roughly $171,000. Let that number sit with you for a second. $171,000 a year, just to afford an entry-level suburban starter home without sacrificing your sanity or your future retirement. According to census distribution benchmarks, an income of $175,000 places a household comfortably in the top 15 to 18% of earners across the nation. That is the startling disconnect in today's market. An average home now requires an upper-middle-class income just to maintain basic financial safety margins. Now, does this mean homeownership is completely off the table if your household makes $110,000 or $130,000? Absolutely not. But it does mean you have to stop playing the game using outdated rules from 2015. If you want to buy a $500,000 property without destroying your financial life, you have three clear, practical levers you can pull, and each one dramatically shifts the math back in your favor. The first lever is increasing your down payment buffer to alter the amortization curve. Most people obsess over getting into the market as fast as humanly possible with the bare minimum 3 to 5% down. But look at what happens when you save patiently and bring a 20% down payment, $100,000, to the table. Your starting loan balance drops from $475,000 down to $400,000. Your principal and interest drops to roughly $2,600. Your private mortgage insurance drops to zero instantly, saving you $1,800 a year. Your all-in monthly commitment shrinks from $4,100 down to roughly $3,400. That $700 monthly difference represents an immense amount of breathing room. That is $700 you can automatically direct into broad market index funds, college savings plans, or an emergency buffer fund that protects you from life's inevitable surprises. The second lever is house hacking, or creating built-in revenue streams within the property. If you are buying a home in today's interest rate environment, treating every square foot as purely passive living space can be an expensive luxury. Countless smart first-time buyers are deliberately looking for properties with finished basement suites, detached accessory dwelling units, or duplex layouts where a tenant pays $1,200 to $1,500 a month. When you bring in $1,300 of rental income against a $4,000 mortgage, your effective out-of-pocket housing expense drops to $2,700. You immediately shift your personal debt ratio from a dangerous 50% down into a safe, manageable 30% territory, allowing you to build home equity while keeping your everyday lifestyle flexible. The third lever is mastering geographic flexibility and questioning the emotional impulse to buy right now. Somewhere along the line, social media convinced an entire generation that renting is simply throwing money away. That is one of the most toxic myths in personal finance. When you rent, your monthly rent check is the maximum amount of money you will pay for housing that month. When you own, your mortgage payment is the absolute bare minimum you will pay. Renting gives you fixed costs, unmatched mobility, zero repair liabilities, and the freedom to invest your surplus cash into liquid assets that historically generate massive compounding returns without property tax bills attached. If the price-to-rent ratio in your current city is heavily distorted, renting a great apartment for $2,200 a month while aggressively funneling $1,800 into index funds every 30 days can easily build you more net worth over a 10-year stretch than stretching your budget to buy an overpriced house at peak rates. Here is the ultimate takeaway you need to carry with you. Real wealth is never about what you look like to your neighbors on the outside. It is about how much peace, freedom, and control you hold on the inside. A house is supposed to be a foundation for your life, not an anchor dragging down your mental health. Do not let external pressure or outdated timelines push you into signing a 30-year contract that leaves you running on a financial treadmill every single day. Take a hard look at your true numbers. Calculate the full picture, including taxes, repairs, and insurance. Build an unshakable cash foundation, focus relentlessly on expanding your earning power, and only buy a property when the math serves your freedom rather than consuming it. You have the knowledge, you understand the real mechanics. Now make decisions that protect your future.